Good afternoon, and welcome to the National Association of Realtors Facebook Live discussion about tax reform and its impact on you as a real estate professional. My name is David Greer. I'm Vice President of Media and Consumer Communications here at NAR. As many of you know, the tax reform bill has now been signed into law. When the bill was debated in Congress, we here at NAR communicated early and often with you about our position, especially how it impacted homeowners, home buyers, and sellers. For more information about homeowners, how it impacts homeowners and sellers, please go to nar.realtor/tax reform for more information. But today, what we really want to discuss is how the new law is going to impact you, real estate agents, brokers and agents in your business, and how the income will impact you. Here to help demystify the new law, I have two of the highly regarded certified public accountants, or CPAs. The first is Peter Baker to my far left here. He is the owner of Business Planning Group. Peter is a tax and accounting advisor who specializes in working with real estate brokers and sales associates. To my immediate left is Evan Lydiard, who is NAR's senior federal tax policy representative and well regarded by all of our members. Before we jump into the discussion today, I want to make sure that all of you know that we are taking your questions. In order to ask a question, just type your question into the comments space below and we'll get to as many as we can. And before we jump in, I just have one disclaimer, and I'm going to read this word for word. In accordance with certain professional standards, we inform you that this webcast is not written tax advice directed at the particular facts and circumstances of any person. This webcast is not intended to contain tax advice. Any material or discussions contained in, forwarded with, or related to this webcast is not intended by NAR or Peter Baker to be used, and cannot be used by any person as a substitute for obtaining their own tax planning in consultation with the independent tax advisors, or for the purpose of avoiding penalties that may be imposed under the Internal Revenue Code. That was quite a mouthful, but we had to get that out there. Okay, Evan, let's start with you.
Okay.
As you and I both know, our members are independent contractors and sole proprietors, and they report their income on 1099s. How does the law impact our members?
Well, there's actually a lot here, and it's good news. There's a big bonus that came along with this tax law in connection with people who are in business for themselves. And that is there's a 20% deduction available on qualified business income. Now, we'll get into some of the details about this, but let's start with an example, a simple example of someone we'll call Amy Agent. And you'll see on the slide here just a moment what this example is that compares the prior law with the new law. Let's assume that Amy has net commission income for 2018 of $55,000. That would be net income. And you'll see that under the current law, there is no such deduction. This is a brand new deduction of 20%. She would get to take over $11,000 right off the top. In addition, she can deduct a standard deduction. Now, under the prior law, that was $4,150. That has been repealed. No longer is available, but the standard deduction has gone up to $12,000. The personal exemption is gone. Standard deduction is up to $12,000. But the taxable income has gone down quite a bit, and she gets a tax cut of about $3,100 compared to the current law. Much of it attributable to this new business income deduction because she's in business for herself.
So this is really quite a benefit for our members.
Very much so. And most of our members will get a big benefit out of this.
Okay, so you were talking about essentially an individual filer. How about those who are married and filing jointly?
Well, this is where it gets a little bit more complicated, but it's still very, very applicable. And if we turn to the second example, that of Andy Agent, who Amy was single, but Andy is married with a couple of kids, and the spouse of Andy also has income, salary income. So as you can see from the slide, under the prior law, they had each $45,000 of income. Andy's through his commission income, Andy's spouse through salary income. No deduction under the prior law, but 20% of Andy's commission income is subject to applicable to this deduction, or $9,000. Now, Andy also loses the personal exemptions. In this case, they've got a
Right.
couple of kids, so it's a big hit.
Right.
But they get a much higher standard deduction. But there's a big deduction here that's going to make a difference. And in this case, Andy and his family are going to get a tax cut of about $2,900. Much of it attributable, again, to this business income deduction. Not all of it,
Right.
but much of it.
Right. So you discussed what exactly is considered non-personal service income.
Well, this comes down to the question of whether somebody is in business for themselves and is earning income from that business. Now, both personal service income and non-personal service income is eligible, but it becomes an important issue when they start getting to the income levels where this phases out. But essentially, personal service income is income earned by your own expertise.
Right.
So me as an accountant, my know-how, my skills as an accountant, Peter, the same thing, an attorney, real estate agents, because they are in business to share their expertise about real estate. That's what they're selling. That's what they're being compensated for. That's their personal income. But also athletes, actors, consultants, people like that are being paid because of their know-how.
So is there a difference between, say, agents and their expertise and, say, brokers?
There could be, yes, because a broker is going to get part of his or her income because of that expertise as well, that know-how. But they may also get income because they got an established business with a building,
Right.
with equipment,
Right.
with intangibles such as name, brand, and so forth that's well known.
Okay.
To that extent, they're getting compensated for their investment in the business.
Right.
So again, this becomes important when you get to the higher levels. And for our audience, it's important to know that this deduction begins to phase out for a married couple filing jointly at $315,000. For a single person, it's half that, or $157,500. There's a phase-out range, and then it's gone. But if you're receiving your income from non-personal service income, then there's an exception that allows you to get a partial or a full deduction depending on how much wage income you paid and how much you have invested in your business.
Great.
Again, it gets quite complex, and these are simple examples, but hopefully you can get the basics here.
But you're doing a great job demystifying. I mean, there's nothing tougher and more arcane than tax code, so thank you.
And it's worth adding to Evan's point when you brought up the broker. Are they impacted differently?
Right.
Well, often the broker's ownership interest in the real estate organization he's running comes to him through a K-1, a pass-through entity,
Okay.
whether it's an S corporation, an LLC, or a partnership. So this concept of the 20% business deduction is really a broad spectrum of both sole proprietors and pass-through entities, including S corporations, LLCs, and partnerships.
Right.
So there might be multiple streams in which a taxpayer
Right.
then has income flowing to them, and each of those streams really are measured in terms of this threshold that Evan described.
So let's get to that, and that's a great point here, is now our agents and brokers, they all pay estimated taxes. What can they, quarterly, what can
Yes.
they be doing right now in 2017 for their taxes? And secondly, let's just start with that. What can they be doing right now? And then will everything that just passed in the new law, when does that take effect? Is that in 2018?
January 1st, with the
Okay.
exception of some of the depreciation items that reached back into this year, and we'll be talking about those later. But regarding the requirement to pay estimated taxes, the fourth quarter payment is due January 15th in a matter of a week or so from now. So most agents should know at this point what their earnings are for this year,
2017.
for 2017. And hopefully then they would be fully paid for what that liability would be. And as you would see on other broadcasts that we've done on NAR here, we've talked about those obligations to pay as you go, to pay quarterly, to make sure agents are budgeting of their commissions earned, or budgeting, setting aside cash that's really designated, not theirs, but if there's payment of tax obligations, both federal and state. None of those obligations change.
So they
in
should
this
still be
new
doing
law.
what they've been doing before.
However, it is worth noting, in general, and this is a generalization, under the new tax reform, tax liability should be reduced in 2018.
For
Right.
most people.
For most people,
Right.
but not all. And so whatever methods they go through to forecast their future year income, they should be looking at it ideally under the prism of this new tax law and hopefully some lower tax rates.
Well, that gets to a good issue, a good question here. So is there any reason a practitioner would want to change their status as a sole practitioner or other status, or is that not necessarily necessary?
Evan, you want to?
Probably not. This business income deduction is applicable whether you're a sole proprietor, whether you're a partner in a partnership, have a limited liability company, or have an S-corp. Either way, you're going to get it if you're in business for yourself and filing taxes on your own return. That's what the whole thing is designed for. So probably not.
So really it's designed so that you don't need to revisit that choice of entity.
Right, right.
And others may ask, it's fair to say, the corporate rate, which we're really not addressing today, also was lowered, permanently lowered under this plan from 35% at top rate down to 21%. So some people that have S corporations or LLC may ask the question, well, should I consider incorporating and taking advantage of that lower rate? And that's a much more involved question. And of course, corporations are still subject to double taxation. The second time is when they pay dividends to their owners. That's taxed a second time. That's a much more complex question. But in general, this 20% deduction of pass-through income or business income is intended that you don't have to revisit the choice of entity.
And indeed, David, the reason this big deduction, this 20% deduction is put into the law is to prevent people from feeling that they have to incorporate to get this lower deduction, because they're seeing regular corporations getting this huge tax reduction. So why not other people who are earning business income through other types of entities? Why aren't they getting a deduction? And indeed they are, because this tax bill, if they had made that big cut for corporations only, everybody would have been filing and becoming a C corporation.
So this is the reason that the tax writers wrote for the 20% pass-through.
Exactly.
This is how we got there.
Exactly.
Okay, so let's talk about the Section 179, the expensing provision. Walk us through that and what that means for our members.
Well, I think most of our audience probably has heard of 179 before. It allows smaller businesses to immediately deduct certain equipment and other assets that they buy instead of having to depreciate it over a number of years. These provisions have been in the code for quite some time, and they've been very beneficial. Well, they got even better with the Tax Reform Act. The prior limit was $500,000 of amount that you could deduct in the first year. Now that's gone up to $1 million. It phases out. It used to be a $1 million phase out, and now it's up to $2.5 million.
So let's, Peter, so clearly the expansion provision is a lot more generous than under the previous. Peter, does that affect owners of real estate, owners or real estate companies?
Sure. To a greater degree, they're more capital intensive. Their offices, office equipment, computers for staff, things of that nature. All of these things would be eligible for the 179, or even as well under this new tax reform, there's bonus depreciation, which was also made much more liberal, allowing for 100% write-off. So it somewhat mirrors what 179 would do, but there are other things to consider in deciding whether you do 179 or a bonus depreciation. But they clearly benefit the larger businesses, larger organizations, brokerage, commercial offices. But there still is benefit in there for the agents themselves.
So both really get a benefit?
Really both.
That's
Anybody
great.
who's in business can take advantage of this.
That's great. Let's go a little bit more deeply into the depreciation. Do you get a depreciation for your car? If I go out and buy a new car and I'm an agent, do I get to be able to depreciate the car?
That has not changed under this new law.
So that's good news.
That's good news.
Okay.
It's not taken away. Your business use proportion, there's obligation or substantiation that's still required of every taxpayer that they can support their business use. But for that business use of your car, there is a deduction, and that would be eligible. As a matter of fact, the new law created thresholds or a more favorable, almost quadrupling the amount of depreciation that you can take on the business use of your car in years 1, 2, 3, 4, and onward. So literally a much more aggressive, faster depreciation for the business use of your car.
I see we have a fair amount of viewers here, and I just want to, if you just joined us, my name is David Greer. I'm Vice President of Media and Consumer Communications here at the National Association of Realtors. We're talking about tax reform and its impact on you as a real estate agent. I have Peter Baker here, an owner of a tax consulting firm, and also Evan Lydiard, NAR's Senior Legislative Policy Representative. We have a question in. I just want to turn to this question from Dennis. Are business expenses still taken like mileage, advertising, along those lines? It sounds like they will be.
Yes.
No differences.
No difference.
Changes. No changes. And talking about mileage, there's the tax, no change here, but the agent or taxpayer has always had a choice between a standard mileage deduction.
Okay.
Again, they're logging or tracking their business miles, and for each business mile, that standard deduction went up this year. It's 54 and some change for a standard mile. Or they track actual expenses. That's depreciation, repair, gas, and maintenance of their car. And really, the savvy agent should be tracking, or taxpayer should be tracking all their actual expenses and then compare, am I better off with the standard deduction this year or my proportional share of business maintenance, actual out-of-pocket costs, and depreciation.
We're getting more questions, so I'm going to turn to our members' questions. This is from Ryan. What does the math look like for Andy and Amy if they're taxed as an S-Corp?
Exactly the same.
No difference?
Well, there might be a difference depending on how much they might have paid themselves as an employee of the S corporation. That's the wild card here for S corporations. They may be taking income as salary, in which case it could change this calculation.
Okay.
And actually, they're required as an S corp. They're treated as an employee of that corporation, and the current code and regulations anticipate that one is paid a reasonable salary for services to that S corp. So that element, that W-2 wages, of course, would have the normal W-2 withholding, Social Security, things of that nature, and would not be part of this pass-through equation.
So to that extent, the S corporation would be different than the proprietorship or the LLC or the partnership.
Okay.
Potentially.
And Ann is asking, does it make sense for a broker associate to incorporate if these tax changes as passed are temporary?
I don't think so, because I don't think they'll be temporary, but nobody can predict the future for sure.
Right.
And what I'm talking about here is the fact that Congress made these individual provisions only in law for 8 years, where the corporate provisions are in law permanently. With the thought, though, that a future Congress would extend them, and they probably will if passed as any kind of prediction. But who can say for sure? What's your opinion?
Well, I agree. And the distinction we're making is the corporate rates were passed as a permanent part of the code. The individual aspects will sunset in 2025. I think
the end of 2025.
However, they're most likely to be extended, whereas the corporate rates weren't. But there's nothing to say that Congress couldn't go in and change the corporate rate.
That's right.
So you really don't want to make such a significant decision as to incorporate for something that easily or historically speaking could change in the future.
And especially not right now. I think, a few years from now, if it becomes evident that that's the direction, then maybe.
Will be.
But right now, I think it's a little rash to do that.
All right. Hold on. Okay, from Leo. If I'm a 1099 and a W-2, how does 20% deduction work for me?
It would be for the 1099 income less any expenses that are attributable to that income, not for the W-2 income. However, when it comes time to figure the threshold for phasing this out, the taxable income of the taxpayer, including any W-2 income, interest, capital gains, that the spouse may have, that the individual may have, all come into play as well. So it's a little more complex than that. But you're going to start with your 1099, subtract your applicable expenses, and 20% of that will be the deduction you look at first.
And what Evan's pointing out is an important distinction. These thresholds that were established, which allow personal service entities such as agents to qualify for this deduction, is measured on their overall taxable income. If you will, line 43 of the Form 1040. And that means your taxable income is impacted, as Evan said, by your spouse's earnings, your earnings, investment earnings, all things that influence retirement, withdrawals, things of that nature. Anything that impacts taxable income is going to be a part of this measurement of eligibility, ability to use that 20% deduction.
So just to remind you, if you want to submit questions, and I love getting the questions from our members, you just have to type into the comment bar below, and we'll try to take as many questions as possible. Okay, we have a question from Leah. Do I need to establish a partnership, an LLC, or can I stay as an independent contractor to get the new business deduction? This kind of, I think, goes back to what we were talking before, is that you probably don't need to. I mean,
exactly. You just stay where you are and you'll be fine.
Okay. So as we got into a fair amount of the questions, one of the things that I wanted to ask you about is some of the negatives on the limitations on the deductions. Is there any for our members?
Well, again, it's going to depend on what other income they might have. If an agent is married to a high income salary earner,
W-2 person,
exactly, and their total income exceeds $415,000, they're not going to get that deduction,
right?
Because their income's too high.
What about entertainment deductions? What if I'm out with a client and I take a client out for lunch? Am I still able to deduct that?
Law under this tax reform, the handling and the treatment of meals and entertainment has changed, and it appears there's aspects of meals that relate to that appear to still be protected, although only 50% deducted. But those
and was it before? Was it fully
before?
It was 50.
It was
before
50
also.
before.
Okay.
Although some items, meals for the convenience of the employer, like in-house, in-office meals, pizza you order for people working on a weekend or something, those could have been 100% deductible. Those are now 50% deductible.
How about we live here in Washington, D.C., or our other office in Chicago? You take a client to a Chicago Cubs game. How about that?
Not deductible anymore.
Not deductible.
That's the part of the law that changed, the entertainment side of that. So Sky Suites, sporting event tickets, shows, things of that nature, pure entertainment are no longer deductible.
No longer deductible. Okay. So we've been talking about tax reform and its impact on real estate professionals. As I mentioned earlier at the top of the program, we've talked a lot about how it impacts homeowners, and I'd like just to have Evan discuss a little bit more how the law is actually impacting homeowners. Tell me, Evan, if a homeowner is likely to calculate whether his or her itemized deductions are higher than the standard deduction, is this going to be complicated or burdensome?
I don't think it'll be very complicated. Most people who have a mortgage or pay charitable contributions, pay state income tax, are going to get a form. They can just add those up and see if their total itemized deductions are above that threshold or not. It's slightly more complicated than just taking the standard, but it can be very beneficial if you do have a lot of these itemized deductions. But back to that major question about how this affects homeowners, because you have that much higher standard deduction, there'll be a lot fewer people itemizing. And that's bad for the industry and for homeowners in general, because no longer will the tax code be rewarding people for owning a home versus renting a home in such across the board fashion. There'll still be some, about 10%, but many others it won't matter. They won't get that benefit anymore.
So let's start off with when the tax bill was first introduced, it doubled the standard deduction, and then I think the House limited the MID at $500,000, and now the
and they also
MID
eliminated the state and local tax deduction.
And state and
altogether.
local was completely eliminated in the House, and whereas the Senate kept it. But in the final bill, it landed up as $10,000, if I'm correct.
That's correct.
State and local property taxes and income for both.
Combined.
That's right.
All fall under that ceiling.
Right. So,
but the mortgage interest deduction was higher, now allowed at the $750. It had been the $500, as you had said.
Right.
And that's now $750 with for both first and second homes.
But only for new mortgages. After December 14th.
Any of the existing mortgages are grandfathered in.
Make that point again for our members, just to make sure that they know.
If a homeowner has a mortgage already under $1 million, They had it before December 15th.
That's grandfathered.
It's grandfathered. They can even refinance that mortgage and continue to deduct the interest up to $1 million. What they can no longer do, though, is deduct interest on home equity loans where the proceeds were not used to substantially improve the home.
Right.
Those are gone, but the first and second home are still eligible for this deduction up to the cap of either $1 million if it's an older loan or $750,000 if it's a loan that was obtained after December 14th of 2017.
So I know that we are at NAR, we did 2 calls for action, and I think over the combined 2 calls for action, we had over 300,000 of our members who answered to let Congress know about, to essentially say that we were initially opposed to the legislation, and then I think Congress did listen to our concerns. Do you agree?
Oh, absolutely, especially at the end.
Yeah.
Because when it became inevitable that this bill was going to pass, we softened our opposition because we thought we could improve the bill, and indeed we did.
Right.
There was a provision.
And we asked for 3 specific things when we, at that point. What were those 3?
Well, we'd already gotten the first one. That is that the 1031 like-kind exchanges not be touched.
And
we were saved on that.
Yep.
The second thing was equally big, maybe bigger in some aspects, and that is the change in the exclusion on the sale of a principal residence. Both the House and the Senate wanted to change that from 2 out of the past 5 years,
5 years.
to 5 out of the past 8,
right.
Which would have been very onerous. And also
and would have hit markets everywhere.
Right.
I know there's a lot of folks who believe that, that the tax law impacts different markets, depending on if it's a high-cost market or not. But that would have impacted every market across the country.
Exactly. And something like 14 to 20% of all homeowners are in between that 2 and 5 year period. And so it would have hit many.
It would have slowed down the market
Absolutely. And so that was left as current law. The previous law was no change at all, which I think was a miracle.
Right, really great. So just looking forward, because I know that there's still that we didn't get everything that we wanted out of this at all. Going forward, do you see us, what would we be looking forward going forward in future Congresses?
Well, it depends on how things shake out overall, and we'll need to talk about this and let this settle. But one thing that comes to mind immediately is the fact that the $750,000 threshold and the $10,000 state and local threshold, they weren't indexed for inflation.
Oh, good point.
Every year, while prices get higher just based on inflation, that incentive becomes weaker.
Right.
So it's going to be fine. It doesn't change that much year to year, but give it 5 years, give it 10 or 15, and it's going to be a shadow of what it is now.
Right.
So those need to be indexed for inflation.
Right, we need to go. So we'll be immediately going to Congress and talking to them about it.
I anticipate so, yeah.
Great. Now, you mentioned briefly about commercial real estate, and that was a big win for us in protecting the 1031 like-kind exchanges. What else did we get in commercial real estate?
Well, there are several things. Many commercial realtors will also be able to benefit from this 20% deduction, which is good. But we also dodged a bullet on a couple of areas, and one is that many large businesses will now have a limitation on how much business interest they can deduct. But real estate businesses have been exempted from that. So real estate did fine on that, and also with carried interest.
Okay.
Most real estate will be fine on that as well.
Yeah, the carried interest remained as well.
Evan, we've talked about depreciation already, but in particular, categories of depreciation that are eligible for either bonus or 179, that definition has been expanding and incorporates many of the things that commercial realtors are addressing and involved in. So the categories of assets and improvements falling under that favorable treatment has expanded in a way that improves or supports commercial.
And that includes leasehold improvements, for example.
Oh, great. Okay, more member questions, and we're going to get to as many as possible during this discussion. A question from Amy. What income amount does the 20% deduction get phased out at? I think you mentioned it.
Well, as a single filer, the phasing begins at $157,500 and then has a $50,000 phase-out bracket. So up to $207,000. For a joint filer, it's double that. It's basically $315,000, and with a $100,000 phase-out segment to $415,000, at which point it is totally lost. We
talked a little bit about whether you should change your filing status earlier. So Joanne has a question here. She just months ago created an S Corp. Can that be negated, and should it be? So she went and created an S Corp. What would you do in that? And I know we're not giving any tax advice, but along those lines, is that something we can answer? Or
I think she should talk with her professional tax advisor on that, because there could be a lot of other elements there that would throw that one way or the
maybe
other.
drove the decision to be an S Corp. And there are some check-the-box rules and regulations that I identify and there's probably some IRS regulations out there. There's a lot of language in terms of how to unwind or in advance some of these elections. So she should speak to her attorney or advisor who helped her with that.
Right, which is, like I said early on, we had to give that disclaimer at the start, which is we are not actually giving tax advice here.
Right.
So if you have a specific tax question, you should really talk to a tax attorney, your own specific attorney.
CPA.
A CPA, excuse me, a CPA. I'm sitting here with two CPAs and I say attorney. Okay. Joe asks a question. What are other changes in Schedule C eligible deduction?
Other than the business and entertainment, or the meals and entertainment, not really
good.
any. No, I don't think there's any negatives there.
For Schedule C, that's the beauty of Schedule C.
And expand on Schedule C. What all is Schedule C?
Think of Schedule C as a profit and loss statement for your business.
Okay.
So it's basically starts with your commission earned for an agent, and then works through all of the expenses you incurred in earning that commission.
Okay.
Of which, of course, your telephone, your travel expenses. We talked about business use of car, computer. Many agents now are using cameras as well. Digital photography is a part of the work
Even
they
drones.
do.
Drones.
Drones and other popular. All of this business equipment. Meals and entertainment, restricted now to just meals and not the entertainment aspect. Home office use. Now, in the broader sense, an employee that has a home office, that's part of a 2% miscellaneous deduction, which was lost to employees. But for a sole proprietor, a professional that runs his business out of his home, he deducts against his scheduled income his business use of his home office.
And that hasn't changed.
And that hasn't changed. So a little bit back to the entertainment. Jenny has a question here. What about client yearly parties, events that I hold for my clients? Will that still be deductible?
I don't think so.
It's interesting. The code calls out a specific area, the holiday party for employees only. And an employees only holiday party is still fully deductible. That did not change. Okay. And it's interesting, if it's in your office, if you invite them to your offices and you're inviting in clients, to me that's very closely akin to the meals, whether you're taking a client out to a lunch or having them in your office for a lunch or a dinner or what have you. So I think you'd need to look at that more closely.
It boils down to if it's entertaining or not.
How entertaining it is. Good point. Marcia asks, with a combined income of over $300,000 in W-2s and 1099, so I think we may have covered this a little bit, and property taxes over $10,000, are there any changes in filing that you suggest?
Well, I don't think that changing anything will result in a better tax situation. They're going to be close to losing the 20% deduction, or starting to phase out that.
Phase out because they're hitting the 315.
Right.
Right. Okay.
But I think more broadly, with that she's talking about, you do have to watch your tax brackets, your income levels.
Right. We talked about this a little bit before.
And under the new tax code, in general, all the brackets, the rate of the brackets were reduced. However, the size of those various brackets changed.
We were talking about that right before we went on air here, and there's a real sizable one between 24% to 32%.
Those brackets,
that bracket
exactly.
There. Yeah.
And they're someone who was at 35 that would hope to drop to 32. Under the new system, might actually be pushed up to a higher bracket.
Right.
Again, depending on their taxable income. So what I always remind real estate clients, or really any small business clients, is watch your brackets and make sure you have in place a retirement plan so that if you need to manage your income in a given year, and you should always be contributing to your own retirement plan.
Absolutely.
Contributions to retirement plans would reduce your taxable income and help you in managing your tax bracket.
Speaking of retirement plans, we have a question from Shirley's. IRA contributions to taxable income, how are they affected?
It's going to depend on whether it's a
Roth
or a conventional. If it's a Roth, it won't have any effect at all. If it's a conventional, you can take a deduction for that contribution.
And that really didn't change under this tax reform. There's really nothing altered.
And just for everybody's knowledge, why don't you describe the difference between a conventional versus a Roth IRA?
Well, a traditional IRA is one that's been around a lot longer, and the idea is you take a deduction when you make the contribution, and then later on when you get the money out, you have to pay tax on that income. The Roth idea is that you put it in without taking a deduction, but when you take the money out, all the earnings come out.
So it grows tax-free.
Tax-free.
Right.
And you never have to pay tax again on it.
That's really, I have 2 Roth IRAs for that purpose. Mindy is asking us, what about client gifts such as closing gifts? Are those and I imagine she's asking is that is still deductible.
It is. There's a very small deductible limit, I think, of $25.
$25, that's right.
It's not high enough, and a good tax reform bill, I think, would have increased that, but it didn't, so that hasn't changed.
So let's just, if you're just tuning in, we've been here talking about the new tax reform law and its impact on you, NAR members, agents, and brokers. I'm going to, if you're just tuning in, I'm going to ask Evan again, why don't you talk to us, how does this impact our members? How does it impact if you're, say, an agent and a single filer?
Well, of course, it impacts the industry in one way, the homeowners. We've talked about that a lot, but in terms of a business person who's in the business of a real estate professional, an agent or a broker, the biggest change is the fact that we have this 20% deduction on personal service income or business-related income that is really a great benefit. If you have $100,000 of commission income, you can, and that's the net amount, you can deduct $20,000 of that and not pay tax on that 20%. And that's a huge benefit.
And then how about for the married filer?
Well, the married filer would be the same. The difference is that the thresholds at where this phases out changes and depends on whether you're single or if you're married. If you're married, it's going to be $315,000. If you're single, it's going to be half that, or $157,500.
Great. Well, and I was just going to say, and what should realtors be doing now in terms of preparing their taxes for 2017, and then what should they be doing for 2018?
Good question. Now that source documents are coming in and they are focused on what did I earn in 2017 and let me start preparing those taxes, they should be able to take on those earnings, begin to project or forecast what will my 2018 income look like? Where will that bracket fall in? What do my estimated payments need to be? And basically do some good old-fashioned budgeting in terms of what they think their taxable earnings will be. And if we've talked about this already, if for any reason they don't have a retirement account open up a retirement account so they can use that as a tool to help manage their bracket. Look at any capital equipment they might need. Now, it's too late to buy capital equipment for 2017, but under the 2018, under the new tax reform, the depreciation and 179 deductions we mentioned are much more generous and have a much greater impact. So if you see that your income is going to be exceeding or approaching these brackets for the 20% business deduction, consider capital equipment purchases if they're needed for your business.
If you can, if your business needs them.
Yeah.
So, hey, Evan, I've been reading a lot in the media since the laws passed. A fair amount of states that do have high property taxes are looking at ways to sort of circumvent or go around the law or reallocate their taxes at the state and local level. Do you see this as something happening, and what impact would that have?
Well, I don't want to discount the ingenuity of state and local legislators who might be able to change their rules and so forth. Some of the things we're hearing about, I think, are a little far-fetched, like the idea that your contributions to the school would be charitable contributions instead of taxes. I don't see how that would work, but who knows? I don't think we should count on anything like that happening anytime soon. That we may see some changes, and I think that there'll be some movements towards trying to make those taxes more deductible, but I don't know. That's pure guesswork and
David,
speculation.
in the end, residents may vote with their feet.
And actually move. I've been reading about that too.
And they do.
They oftentimes do.
And so the lesson for a state is to have a competitive budget and be an attractive state to have a residency in.
Right. And again, we discussed this a little bit before. Going forward, NAR was so active on the tax bill and tax reform, and we started out with where it didn't look good for us, but we really landed up doing really well. Again, can you, and I'll tell you, it was because of our advocacy efforts. Our advocacy efforts, 300,000, the largest ever a call for action, over 2 calls for action. We had people telling Congress that not to do harm to the tax system. And I think Congress really listened to us. And as you said earlier, that when we knew this thing was going through, what did we finally decide? What were 3 things we thought we could get out of the bill?
Well, an improvement to the state and local. They added income as well as property tax.
And there was zero. They took it all out in the House bill. Right? There was no deductibility.
Initially in actually the Senate bill.
Oh, the Senate, sorry.
Yeah, I misspoke before.
Okay.
So we got the property and income tax part of it. Again, the big exclusion, the fact that they had put big limits on the exclusion on the gain of the sale of a principal residence was kept in current law. And then another big victory is on the 1031.
1031, which I know our commercial realtors are really happy about that, because that's really going to keep the liquidity in the market and the market flowing.
Absolutely.
When we started lobbying on 1031, most members and staff on the Hill didn't even know. They thought maybe it was at what time for coffee or something.
Right.
They didn't know what 1031 even was. But by the time we finished, with the help of other real estate interest groups, we really had made a lot of members aware of how important it is to local communities.
So if there was one piece of advice between both of you under the new tax law, and you're a real estate agent, what would you say they need to be doing looking forward?
Well, paying attention to what's happening, of course, as always, paying attention to what we're doing here at NAR, and being willing to participate in calls for action as they were before. We're just so happy that we have such an active association that leaves all other ones in the country in the dust in terms of participation.
How about you,
I would
Peter?
add, as a tax preparer for my clients in the business, know your numbers, be setting aside money for taxes, quarterly tax estimates, and meet with your tax advisors or seek whatever resources you can about understanding the topics we talked about today, this 20% business deduction, other expenses that you can utilize in your business, and you're running your own business. Be smart and know your bottom line. Absolutely, absolutely. Well, I'd like to thank both of you for stopping by and willing to talk about this. And we will be archiving this Facebook Live discussion at NAR's YouTube channel, where you can share it with your friends. And we will be discussing more details as the tax plan, because I know a lot of everyone's still diving in and finding what's all in that, and we'll be making our point known. Thank you for taking the time to spend the past hour with us, and have a great day.